Good morning, everyone. Thanks for joining the weekly research morning call. There's quite a few stock counter updates, followed by the Euro technical pause and Singapore weekly. So without further ado, I'll hand over to John to present on AMD. John, please.
Thanks, Mel, and good morning, everyone. So I'll just start on AMD's fourth quarter results, which they issued last week. Um, Overall, revenue was actually in line with expectations, but their PATMI or their earnings was quite a bit above, mainly because of higher interest income, as well as lower tax expenses. But the big thing for AMD is that we're starting to see their data center and their client, which is the PC segment, start to actually really expand and then start to drive revenue growth especially moving forward. What we saw, in the red box here, you see data center up 38% and client PC up 62%. So on the data center side, a lot of it has to do with their GPUs, which is the MI300X. And so this is a direct competitor to NVIDIA's GPUs, which are, your higher performance meant for AI and inferencing work. And one of the reasons why we're seeing accelerating demand is because AMD actually only launched this product early last year, or early to mid last year. So it really only benefited from about like one quarter, which is the fourth quarter of being able to scale and ramp up supply for its AMD's GPUs. At the same time, their server CPUs, which are just your normal, your higher end CPU chips, are actually gaining share from Intel being used in data centers. Intel right now, I think, close to 80+% market share, and similarly, AMD's CPUs are also, I guess, relatively newer compared to Intel. So obviously, when you're starting off small, you have less market share. But something that we're seeing is that more and more cloud service providers are actually and data centers are actually transitioning from Intel to AMD because of AMD is making a little bit more competitive products at a slightly cheaper price point. Now, in terms of moving back to the GPUs, which is really what's expected to drive demand moving forward, the MI300. So they actually guided for their MI300X revenue or data center GPU revenue to be about $2 billion for 2024. Over the last earnings call, because of higher customer orders and customer commitments, they've actually raised this number to $3.5 billion US dollars. So almost doubling in terms of expectations. And so this kind of just indicates that the AI hype actually is still very strong. More and more customers are trying to leverage on this AI technology, and because of that, they need to have better infrastructure, especially better cloud infrastructure moving forward. And with the dominant player being NVIDIA, we're starting to see a little bit more market share gains from AMD, mainly because their products, right, their latest product is almost as good as NVIDIA's GPUs, and they are kind of offering it based on an open source infrastructure format. So it's more accessible to a lot of I guess AI enterprises who actually want to leverage this kind of generative AI technology. In terms of the main weakness, gaming and embedded segments, which are the chips in your consoles, like your PS5, your Xbox, as well as your chips in your smart fridges or medical imaging devices and so on. This continues to be a drag, and both segments were down like 17% and 24%, so quite significant declines. And it's expected to continue, at least for gaming. In terms of embedded segments, the decline is supposed to at least kind of stabilize. In terms of sequential growth from the second quarter to the first quarter, this should be roughly flattish, and then it should start to pick up towards the end of the year, especially as a lot of the customers normalize their inventory levels and start to actually purchase more units moving forward. Because most of their customers are in growth sectors, just that they had this glut of inventory that they're starting to at least normalize, and so they haven't really been purchasing that much over the last year and bit. In terms of guidance, like I mentioned earlier, they raised their MI300X, which is data center GPUs. That's really the North Star for them. It's really what we expect and what they expect to drive revenue growth moving forward. in their overall data center business, we expect their revenue to increase about 80 to 85% year on year for this full year, which is quite significant. And most of this will come from their data center GPUs. We actually, in terms of valuations, we actually upgrade from a neutral to an accumulate. We also raised our target price from $110 to $195 because we double our 2024 PATMI estimates to 3.4 billion. And we also roll over an additional year of valuations. Our WACC remains unchanged, but we raised our growth rate to 5% from 4% on stronger AI tailwinds. We think moving forward, data center GPUs are going to be front and center for NVIDIA. Right now, the data center business accounts for about almost 50% of their overall revenue. Obviously, this we think will continue expanding, and so it'll start to be more and more integral into their overall revenue. And with AI tailwinds not abating, we think that they're well positioned along with its main competitor NVIDIA to benefit from these kind of tailwinds. And so that's why we actually upgraded from a neutral to an accumulate. Moving on to my next house, which is Alphabet Inc. They so issued their fourth quarter earnings last week. In terms of results, roughly in line with expectations. So the big standout here was PATMI, which grew 52% year on year on higher operating leverage. Mainly because they have a much leaner workforce and real estate footprint right now. They've cut quite a number of jobs over the last year, especially at the beginning of last year, and they're starting to see the full benefits of a much more leaner team, coupled with the fact that top line growth is actually accelerating because of the recovery in digital advertising. The main thing for Alphabet is that they too have been leveraging on AI technology for quite a while, more than 10 years, and they're integrating a lot of the generative AI functions into like search and YouTube advertisements and all that to deliver a higher ROI for advertisers as well as more efficient ads. And so that's for the difference between a company like Alphabet and AMD is that AMD really benefits directly from higher demand, whereas for Alphabet they have to leverage the technology to improve their products, and then so the flow through in terms of revenue is a little bit slower because you improve your products a little bit by a little bit, and then by adding more value, you're able to charge more. But obviously, this doesn't happen overnight, like a lot of the infrastructure or semiconductors. So it's a little bit just a slow flow through. In terms of main knock on the earnings is that the company actually mentioned that they'll be increasing their 2024 capital expenditure significantly. Last year they had about $31 billion in capex. For this year, we expect somewhere in the range of 38 to 40 billion, so quite a significant increase. And most of this spending will go into building more servers and data centers to support its own AI developments. So they're really doubling down on leveraging AI technology. And even though it is a little bit difficult to see now from a consumer standpoint, because it's just minimal incremental improvements in their products, over time you should be able to see kind of this transformation in terms of what search advertising can do, or even like what you see on YouTube. In terms of outlook, we expect continued monetization for YouTube, especially for YouTube Shorts, which has been a laggard for quite a while. And we do expect cloud growth to continue at a healthy rate, about 20-25% year on year, mainly due to a lot of AI tailwinds from early adopters that they are trying to get in. Because right now, I mean, if you talk about AI, the AI industry is still relatively early on, and so a lot of the early adoption coming from enterprises, they're looking for cloud providers like Alphabet, for Microsoft, and for Amazon to leverage this kind of AI technology on. In terms of our valuations, we actually downgrade to an accumulate based on share price movements, but we raised our target price to $154, up from $144. We cut our PATMI for 2024 by about 5%, mainly due to increasing R&D investments in AI. But we also roll over an additional year of valuations. That's why we raised our target price. We think that moving forward, with the recovery in digital advertising, Alphabet should really, since they are the dominant player, they are the monopoly in a lot of these industries, they should stand to benefit the most. It's really between them and Meta. These are the two major digital advertising companies. And as long as they continue to improve their technology and deliver better ROI efficiencies for the advertisers. It's very difficult for advertisers to actually switch away because there are not that many options. So that's why we still think that it's mainly going to be industry driven for Alphabet because they are the main player there. Yeah, so that's all for Alphabet. I'll hand it over to Ambrish to talk about Microsoft. Thank you.
Thank you, John, and good morning, everyone. So moving on to Microsoft's second quarter 2024 results. Overall, the revenue, it was in line with our expectations, whereas PATMI came in ahead of expectations mainly because of higher operating leverage. So in terms of its overall performance for the second quarter, its total revenue, it grew by about 18% year over year. And this was mainly because of the cloud computing strengths like Azure. It's the second largest public cloud provider. And the Azure revenue, it grew by about 28% year over year. And this was mainly because of new workloads which they shifted to the cloud and as well as growing AI contribution. So management highlighted that it's witnessing like the generative AI applications that are developed by the enterprises on Azure's platform. They have been scaling up, and as a result, it's leading to higher usage and consumption, which in turn benefits its Azure revenue. So secondly, Office 365, Microsoft, it has in the productivity market, it has a 90% market share. And despite this, Office 365 revenues have been growing in double digits. And in the second quarter, the Office 365 commercial revenue, they grew by about 16% year over year. And this was mainly because of the number of paid users. They grew by about 9% to about 400 million. And it mainly came from the small and medium enterprises, mainly because there was a need to manage tasks and workflows. And also it also benefited from the higher average revenue per user, mainly because the users, they upgraded to a E5 license at the time of renewals, mainly because of higher security. And lastly, in terms of its profitability, it's currently focusing to have a cost discipline, and as a result, it's leading to a significantly higher operating margin. It grew from about 39% in the second quarter of 2023 to about 44% this quarter, and it was mainly because of the high operating leverage. So management highlighted that its headcount was about down about 2% year on year. So moving on to the outlook, in the third quarter of 2024, Microsoft expects a total revenue growth of about 15% year over year. And this should be again driven by its core products, which are Azure and Office 365. So Azure revenue, it's expected to remain stable at about 28% year over year growth. So the company, it's also witnessing a traction in its generative AI capabilities, like wherein it's through its Azure AI services, it's basically helping the developers and the companies to build their own generative AI solutions or applications through a pre-built or a template, basically, which can be customized. And it's providing capabilities like content generation, summarization, as well as image processing and audio generation. So it's also integrated its AI into its the products like Office 365, wherein it's expected to boost the productivity for its users. Like for instance, it can generate the draft of a PowerPoint presentation through PowerPoint, and also generate text through Word. So it's expected to witness boost productivity for its users. And however, it's a company highlighted that it's witnessing early traction. It's not significantly expected to have a significant major impact on its top line growth. And in terms of its operating margin, it's expected to grow by about 1 or 2% year over year for the full year of 2024 to about 44%. And this is despite the significant high AI investments. And in terms of its valuations, we maintain accumulate recommendation, whereas we have raised our target price to about $450 from the previous $375. And this is mainly because we increased our full year revenue by 1%, mainly because of the AI tailwinds, and we increased our by about 3%, mainly because of the high operating focus on operating leverage, mainly because of low expenses. Our WACC remains unchanged at 7.2%. However, we have increased our growth rate to 4.5% from 4%, and mainly because we expect that there has been significant demand for the large language models, and it's expected to boost the demand for its Azure platform, mainly because of the storage and cloud computing solutions, and also with the increased adoption of the Office 365 Copilot AI tools, it should help to boost the top line for Microsoft. And also, there have been it could benefit from the demand for cloud gaming. Recently, it has acquired Activision Blizzard, so it's expected to boost its Game Pass subscription service as it has gained access to the popular gaming titles like Call of Duty. So that's all for me. I would now like to pass on to Glenn.
Thanks, Ambrish. Yeah. So for me, we have Singapore SGX. So they released their results sometime last week. This is their first half FY24 results. For their first half FY24 revenue of 592 million, it was slightly below our estimates at 45% of FY24, while the adjusted PATMI of 251 million was also below our estimates at 42%. And this variance came mainly from higher than expected FICC revenue, which was offset by lower equities cash as well as equities derivatives revenue. I'll go into more detail about this later. However, for their dividends, they increased their dividends by 6% for the first half to 17 cents. So this is higher than the previous year's 16 cents. Now, for the positives, first positive, mainly that their treasury income has continued to climb, and their first half total treasury income on collateral balances rose 47% year on year to 67 million. And this was an increase of around 20 million from the previous year's 47 million. And this increase was mainly due to the higher average yields on margin deposits, which was partially offset by a decrease in margin balances. However, this was actually lower than the record high of 90 million, which was reached in the second half of FY23, which was the previous half. Now, notably, their first half's treasury income still contributed 20% to their profit before tax, which is similar to the contribution in full year FY23. For the second positive was that their FICC currency and commodities trading and clearing revenue surged 30% year on year to 148 million, as the volumes increased in the commodity and currency derivatives, primarily from the iron ore futures, which was up 49% year on year, and the USD CNH FX futures, as well as higher contribution from their OTC FX business. And the OTC FX business actually contributed 40.9 million or 7% to their first half revenue. This increase was primarily due to higher volumes in currency swaps from clients managing interest rates risk. For the third positive is that their platform and others revenue accounted for 20% of total revenue and grew 8% year on year to 120 million. The market data revenue rose 10% year on year, which was driven by higher revenue realized from securities and derivatives market direct feed subscribers, as well as growth in distribution of commodities data, while connectivity revenue grew 9%, mainly due to higher revenue from co-location subscribers. So the last segment of their platform and others revenue, which is their indices and other revenue, also increased 7%. This was mainly from higher revenue contribution from the energy market company and indices. For the negatives, the first negative is that their listing revenue continues to decline. Their FICC fixed income revenue fell 8% year on year, which was dragged down by lower listing revenue. And their cash equities revenue was also 6% lower year on year, mainly due to listing revenue dipping 3% year on year, as well as their trading and clearing revenue falling 14% year on year, as there was a dip in their daily average traded value, total traded value, as well as overall average clearing fees. For the second negative is that their derivatives at volume and fees both dipped. Their total equity derivatives volume dipped 14% year on year, as volumes of the GIFT Nifty and the FTSE China A50 Index futures contracts declined. And the average fee per contract for their equity, currency, and commodity derivatives was also lower at $1.54 as compared to $1.58 in the first half of FY23. And this was mainly driven by a decline in the average fee of the Nifty 50 Index futures due to the movement to the GIFT Connect, which is the National Stock Exchange of India. So, but nonetheless, if you look on a pro forma basis, the first half average fee per contract actually rose slightly by 1 cent as compared to the previous half. As for the outlook, we believe that the OTC FX business will continue to be their main growth contributor, and this comprises of their BidFX Max Trader and their electronic communication network. And it has continued its strong growth with their full year FY25 average daily volume target of $100 billion well within reach. They've actually reached it for the first half. They have reached 100.1 billion for the first half, but I think on a full year basis, they are well on target to reach this 100 billion. Their OTC FX business is also well positioned for growth, and they have a focus on digitalization as well as risk management services, as it aims to capitalize on the emerging market opportunities. And as there's more participants engaging in emerging market currency transactions, SGX's platform stands to benefit from this trend. However, they are also cautious on the near-term outlook as the global growth aspects appear muted due to rising geopolitical tensions and economic divergence. And as such, they have guided down their FY24 expense growth, and this will be similar to the 3% year-on-year expense growth in the first half. And this is lower than their previous guidance of mid-single digit for full year FY24. And they have also guided down their capex, which is expected to be within 70 to 75 million, lower than the previous guidance of 75 to 80 million. And lastly, the higher for longer rates also benefits SGX, and they will be able to expect that their treasury income will remain high as the rates continue to remain high. As such, we downgrade to an accumulate with a lower target price of $10.53 as we lower the FY24 earnings by 3% as we lower equities, cash, and derivatives revenue estimates, but lower total OPEX estimates for FY24. The catalysts for SGX include continued growth from their OTC FX business pillars, as well as continued high treasury income due to the higher for longer interest rates. So that's all I have for SGX. I'll now hand it over to Darren. Thanks.
Yeah, thanks, Glenn. Good morning, everyone. So this is an update on FCT. They released their results as well as the acquisition 2 weeks ago, but also reservice. So sorry about the delay. For this business update, there were no financials provided as usual. So they only provide financials in every half year. So for this business update, for the positives, their retail portfolio occupancy right now is already almost full. So right now it's at 99.9%. It's improved slightly quarter on quarter. So management, they guided that the rental reversions for this quarter were above the full year 23's rental reversions of 4.7%. So for us, we are predicting or rather expecting a full year 24 forecast of 5% positive rental reversion. And the other positive for them is that their gearing right now, it improved to 37.2%. This is mainly because they use some of the divestment proceeds from Chinese Centrepoint as well as the Hector REIT to pay off some of the outstanding debt. And so now it's at 37.2%. And the all-in cost of debt, it increased slightly 30 basis points to 4.3%. And right now, 63.4% of their debt is on fixed rate. So the good thing for them is that right now they do not have any refinancing risk for the rest of FY24, as they do not have any debt expiring this year. So for the negatives, the tenant sales, it slowed down to 0.7%. Rather, is negative 0.7% year on year in the first quarter of 24. This is mainly because of several key tenants undergoing renovations as well as the higher base in FY 2023. So if you exclude the several key anchor tenants undergoing renovations, the tenant sales would be up 1.1%. So this is about this tenant sales level for them is about 18% above pre-COVID levels, and the demand is still coming mainly from F&B. So F&B, the demand is really strong. Shopper traffic for FCT right now is it was up 3.1% year on year. So a little bit about the acquisition of the additional stake in Next. So FCT, they are acquiring 24.5% stake in Next from their sponsor. So that's the sponsor's full stake. And this will bring FCT's total stake in the Next Mall to 50%. So this is based on a purchase consideration of 523 million. And this is based on the agreed property value of about 2.12 billion. So this 2.12 billion is about 2% higher. This property value of 2 billion plus is about 2% higher than when Next first purchased the original stake last year for a 25.5% stake. So for FCT, this purchase consideration was about comes with about 4.8% MPI yield. So it's also similar to the MPI yield for the original stake that they purchased last year. So the funding for this will be private placement. So they raised, or rather they raised 200 million. So the private placement was 2.5% oversubscribed and is at an issue price of $2.18. So partially funded by this private placement and as well as debt financing. So we like this acquisition a lot because we think Next is a high quality asset and there's a lot of potential for more organic growth internally for Next. As well, so we also think it's a good strategic fit for them for their diversified portfolio. So after this acquisition, FCT will be the largest suburban retail space owner in Singapore. So this gives them a lot of bargaining power with the tenants. Like they can give the tenants option to move locations and such. So yeah, it's a plus for them. So this transaction is expected to be 0.4% DPU accretive to FY23's pro forma DPU. So this is based on 4.8%. Sorry, this is based on 3.8% debt financing cost. So there's also a further upside potential for them if they are managed to, if FCT is able to restructure the holding company into a limited liability partnership. So if they are able to do so, they'll be able to get this tax transparency, and this will result in about $7 million in savings. So this it will take a while. It won't be so immediate. So maybe if they're able to do so, it will take maybe about two years for this to come through. And for them, the post-acquisition gearing will be about 37.8% after you accounting for the private placement shares and debt finance, the new debt taken on and such. Yeah, next slide, please. Yeah, so for the outlook for FCT, the tenant sales are still resilient, 18% above pre-COVID levels, and the occupancy cost right now is about 15.5%. So it's relatively healthy, and this will help to underpin the potential to raise rents further. So like I mentioned, we expect about 5% positive rental reversions for this full year. And further inorganic growth opportunities will come from the acquisition of the sponsors, North Point City South Wing. And they also have potentially could acquire the remaining 50% stake in Next, but not from the sponsor. The sponsor's stake was the stake that they've already purchased. So for the Tampines 1 AI updates, the first batch of the Tampines 1 AI works completed in December, and some of the tenants have already commenced operations, and the full completion of this AI works will be expected September 2024 this year. And almost all of the space has been pre-committed to date, so 97% of the space pre-committed. So with that, we maintain our accumulate call, but then we have a higher DDM target price after we account for this acquisition. So we raise our DPU estimates by about 1% for the next 3 years. So FCT right now is trading at about 5.2% dividend yield. Yeah, next slide, please. Yeah, so the next couple of slides actually are Peggy's slides, but she is attending the Keppel infrastructure briefing. They announced an acquisition today, so they have a briefing during this time. So I'll just help to speak on her behalf. So the main thing for Keppel is that the call is downgraded to accumulate, but that's because of the recent share price performance. The target price, in fact, has been raised from $7.52 to $7.98. But basically because of the share price performance, that's why the call is a downgrade from a buy to accumulate. Yeah, so for Keppel's full year 23 results, the net profit was in line with our estimates rather. So it grew 5.6%. So the recurring income grew 54%, and it now accounts for about 88% of net profit. So the chunk of the recurring income comes from the infrastructure business. So infrastructure made up about 90% of this. So the positive for this was that the infrastructure, it almost doubled. As you can see in the chart there. This is mainly due to the improved energy spark spreads from the integrated power business. and as well as the higher fund management fee from Keppel KIT. So for KIT, because they changed their fee structure to include the distribution payment. So for last year, KIT they increased their distribution. So as a result, they also receive a higher fund management fees as well. So that is a plus for them for the infrastructure business. Another good thing for them was the connectivity business. Like they had a higher operating gain from M1. So for M1, they acquired Malaysia ICT in 2022. So as a result, they grew their enterprise customer sales base as well as the customer base last year. And for M1, they also had a strong recovery in roaming revenue. And right now it is at about 80% of pre-COVID levels. So management, they do not think that this roaming can recover to 100%. So they think this recovery of roaming likely take around this 80% level. Yeah, so for the negatives for Keppel is that their real estate business was impacted by higher interest expense as well as lower fair value gains from the investment properties. Yeah, so they also were impacted by $111 million loss on the distribution in specie of Keppel REIT units. So this is because when they issued it, or rather when they distributed the Keppel REIT units, the value on the book was basically higher than the market value. So as a result, they had to take a loss on books, booking some loss in for the units that they distributed. And for Keppel also, their recurring income from fund management, it fell 5.5%. So as you all know, the fundraising environment wasn't too good last year as interest rates were so high. So as a result, they were only able to raise 5 billion. So this is relatively slow, and we think things will get better. Like fundraising environment will be better in 2024 as well, as there's more stability in interest rates, and possibly towards the later end, interest rates might even decline. So we are expecting better fundraising environment for this recurring income side. And for them, the net gearing, it rose to 0.9%, and management, they have an internal net gearing threshold of about 1 times. So the free cash flow was negative 228 million last year, and the interest expense, of course, impacted them as well as other companies. So interest expense, it doubled to 228 million. So for the outlook for Keppel, the energy side, especially for the infrastructure sales, they provide a stable and visible earnings base, and the new capacity will only come on stream in early 2026. So this will the energy infrastructure side will continue to be rather stable and is visible and recurring. And yeah, and like I mentioned before, we do expect improved fund management, fundraising environment in FY24 to continue to grow fee income, especially now that interest rates are more stable. Yeah, next slide, please. Yeah, so this is Peggy's valuation. So as you can see, the sum of the parts valuation, a lot of it is based on the REITs. So that is a moving thing based on the REIT share price. Yeah, so I'll just leave it here for seconds for you to take a look. Yeah, okay. Next slide, please. Yeah, so next is air transport sector. So this is also Peggy's slide. Yeah, so for air transport sector, we are overweight. We are underweight. Yeah, we are underweight mainly because the SIA that if we think that the SIA that is the passenger load factor, it fell. I mean, not we think it did fell, but then usually in December the load factor is its highest, but then in December it fell 0.3 percentage points. So it's the first decline since September 2021. So we think this could point to a peaking air travel demand. So usually December is highest, but then despite that, it still fell. So yeah, probably peaking, and then we are not sure whether it could recover. But this basically means that if SI they wants to get this load factor to pick up rather, then we should expect that they have to decline, they have to lower their fees, or rather the cost of the flight. because if they travel without any passengers, is way worse than lowering the cost of the flight, or rather the price of the tickets. Yeah, so we're expecting some weakness there. And then in January also, there was this issue with the Alaska Airlines. So as a result, there was grounding of about the B737 MAX 9. So there's some capacity reduction there. And there's also but the good thing is that there's a continued recovery in the China air travel volume. So December international passengers, it rose 10 times year on year, but it's still 37% below pre-COVID levels. So 37% below December 19 levels. But the good thing for China is that the cargo volume is surged quite a lot and is much higher than the pre-COVID level. So we have a chart later. So the cargo volume worldwide for it grew by 8.3%. So past months there was a kind of a diversion of cargo from the Red Sea crisis, but we see it less likely happening now as sea freight rates have already normalized. So yeah, so that's okay. Yeah, next slide, please. Yeah, so you can see in the chart, passenger load factor volume as a percentage year on year, the SI load factor is decreasing. Yeah, so that's the first decline in passenger load factor since September 2021, and like I mentioned, this isn't a good sign as December is supposed to have a higher load factor due to more travel, but even though even such is as even though it's supposed to be more, but it still declines, so isn't a good sign. And the Scoot share of SIA passenger volume is also increasing. So that is rather a lower cost, so they get the passenger seat kilometer per hour per share is also lower. So we a lot of the flights are to nearer areas such as like the Southeast Asia region like Jakarta, Indonesia, Vietnam and such. So yeah, the passenger seat kilometer per share is also lower. But the number of passengers per share for Scoot as a percentage of SI volume is more, and leisure travel is basically fueling the travel recovery and not so much corporate travel. Yeah, next slide, please. Yeah, so for this, the industrial passenger volume, the industry passenger volume growth, it eased year on year in November. So Asia Pacific is still leading, but there's some weakness in North America and as a total market as well. So yeah, yeah, but the next is North America cargo volume rebounded in November. So that is the green line. Yeah. Next slide, please. And yeah, so this is the China international PAX volume as compared to pre-COVID levels and a year on year. So you can see the orange line basically, it is still 37% below pre-COVID levels, and on a year-on-year basis, it's almost 10 times growth. Yeah, so China is improving, but it's still lagging pre-COVID levels. And the cargo volume for China is a plus because it's right now is much stronger than pre-COVID level 34. So this likely benefit sets. So yeah, next slide, please. Yeah, that's all for me. I hope I did Peggy justice. So yeah, hand over time to Meow Meow. Thanks.
Thank you, Darren. So Lendlease reported first half 2024 result. Overall is within our expectation. DPO slide 14.5% year on year to 2.1 cents due to higher financing cost. Achieving a rental reversion still look resilient, achieved 15.7%, with Somerset contributing to 20% and GEM delivering stable support of 10%. We expect rental reversion in high teens for Somerset and low teens for GEM through the remaining of the calendar year. And we don't expect any impact on DPU from the departure of the master lessee in Building 3 of Sky Complex in Milan, as the tenant has paid 2-year rental supplements, and L-rate will distribute over the next 2 years. The building is sorted for multi-tenancy, and we expect it to be backfilled by first half 2025, which roughly takes a year. Leasing prospects looks promising now, with commitments of few floors, and there's 27 floors in total. Current rental for the new buildings nearby ranges from 310 to 350 euro per square meter. That's 65 to 85% above the previous rental paid by Sky Italia, the anchor tenant, thus providing rental upside for REIT. It also paves the way for future divestment. Given the improved operational position, there's reduced concentration risk from 13.6% to 10.2% by GRI. And upon restructuring, the early termination cost has also been removed, thus providing stable cash flow till 2033. The asset currently valued at 290.5 million euro, which will lower the gearing to 32% from the current 14.5% level upon divestment. REIT is currently trading at FY24 dividend yield of 6.82% and 0.79 times price to NAV. We expect upside from mark-to-market rental uplift upon successful backfilling of Building 3 Sky Complex, and better than expected international travel numbers to support further rental reversion in Somerset. Factoring higher for longer borrowing costs, our DBM back target price has been adjusted downwards to $0.83 from $0.86, with projected FY24 to FY25 DPU of 4.16 to 4.59 Singapore cents. And we raise our FY24 interest rate assumption by 0.2 points. So it's halfway of the fourth quarter to 3 result season, and here's a consolidated table of the year-on-year net profit income and DPU performance. Overall, among the 21 REITs reported their earnings, 71% experienced a negative DPU growth, and with average decline of 10% in the first half 23. 2 of them didn't report any financial updates. So ESR Logos and Sabana REITs experienced the highest decline in DPU. And DPU drop for Sabana REITs was mainly due to decreased payout ratio to 90%. FY23 DPU would have matched the FY22 level if not for the decision to returning 10% income. And the decision stemmed from considering costs incurred and anticipated expense associated with the internalization process. And 5 million was spent in second half 23. And going forward, we foresee even more uncertainty on the REITs due to ongoing litigation with the master tenant at 33 Penjuru Lane, and also the additional costs incurred by the internalization process. And the second one is ESR Logos rate. Although NPI was higher year-on-year, distribution income was diluted due to higher financing costs and an enlarged unit base resulting from the recent 300 million equity fundraising, which increased the share base by 13%, leading to dilution in DPU. Approximately 440 million in divestment was carried out in FY23 and was executed at 1% above premium of their valuation. The divestment combined with enlarged share base, we may exert pressure on DPU in the near term. But despite this, the expectation for DPU will gradually improve in the medium term as the proceeds from divestment will gradually deploy to acquisition, AEI, etc. That's all from me. I'll hand over to Zing for technical pause.
Thanks, Melmel. Good morning, everyone. I'll move on to the technicals. So first up will be S&P 500. Last week, we saw the bullish momentum continuing, currently nearing a retest of the main uptrend channel resistance. So that's above the 5,000 points level. So for this week, we're likely to see resistance at 4,975 to about 5,030 area, while the support is likely to be between 4,850 to about 4,900 area. Next slide. So for ETF monthly for January, most of the asset classes were flat or down 1 to 2% in January. So with the outliers being S&P ETF, which gained about 1.6%, and the Hang Seng ETF, which was slumped over 10%. As for their current trends, S&P 500 is in an uptrend. Most of them are in a range consolidation, except for oil and Hang Seng Index, which remain in downtrend. Then in terms of our outlook for February, I think we could be seeing more price consolidation take place this month. While for S&P 500, we are likely to see a pullback after a strong bullish run from November of last year. As for oil, it could extend its downtrend further this month. Next slide. So the first up will be the S&P 500 ETF VOO. So looking at the chart wise, we continue the bullish momentum in January after a breakout of a range consolidation. And currently we are near a retest of the main uptrend channel resistance. So that could reach a sell area of close to above 460 US dollars. Then when we look at the RSI, it's also currently at an overbought level above the 70 level. So possibly we could see a bit of a pullback this month. Next slide. Okay, next up will be the Treasury Bond ETF IEF. So for this, January was largely in a range consolidation mode as it traded outside of the uptrend channel with a bit of slowing momentum. So for February this month, we could see the range consolidation continue with resistance still holding above 97 to about $98, which was the previous swing high levels in April of last year. Now, next slide. Okay, the next one will be the oil ETF. So for this, when we look at the chart, we can see that in January, it continued to face selling pressure at $140 level, which was the wedge consolidation resistance in blue. Also, this was confirmed the downtrend channel resistance as well. So currently it's still trading in this downtrend channel with weak momentum. So potentially in February, we could see the price come down a bit lower towards the $123 to $127 area, where it will retest the consolidation wedge support, where it could find some relief bounce thereafter. Next slide. As for the Bitcoin ETF BITO, generally we saw quite a bit of a range consolidation take place. Yeah, so for February wise, I think we could still see a bit of consolidation as the price recently retested a support around the $19 level and rebounded, but we are likely to see resistance from about $21 to $23. And so we could see the range continue this month. Next slide. Okay, next one will be the Singapore Equities ETF, ES3. So for this, we generally saw a pullback from a retest of this uptrend support line in blue, which was assessed at a $3.30 level. And currently we are doing a bit of a range trading. So I think in February we could see some range continue for the Singapore Equities ETF, as there's still some near-term support at 3.16 to 3.21. Next slide. Okay, last but not least will be the Hang Seng Index ETF. So for this, January we saw a slump after the price broke down the $55 support level. It's currently still trading in this downtrend channel with weak momentum. So but in January we saw a retest of the $50 level, which was close to the previous swing low recorded in October 2022, before we saw a huge rise in the months thereafter. So if the swing low on the previous month hold, we are likely to see some range consolidation this month. But we still expect selling pressure above $55, which was the recent breakdown level. Yeah. Next slide. Okay, moving on to the Thai SDR monthly for January. The price action was actually quite muted. Airports of Thailand was basically unchanged. PTT saw a slight gain of about 0.33%, while CPO was the biggest loser, down over 6%. And in terms of the current trends wise, I think all three of them are currently in a range consolidation mode. In terms of outlook for February, there could be some rebound this month, as airports of Thailand and CPO could trade higher from the recent as there's some recent increasing momentum in their in the charts. As for PTT, the price is expected to remain a bit flattish with some near-term resistance. Next slide. Okay, so for airports of Thailand, we look at the chart. January has been quite range-bound for a while. But there has been increasing momentum in both the MACD and RSI. Also, we saw a higher low being formed in January. So potentially, we could see some form of a bounce towards above 65 to 67 Thai baht, where 65 was a previous support breakdown level, and we could retest the downtrend resistance line as well if there's some strength coming in. And so potentially there could be some bounce for airports of Thailand this month. Next slide. Okay, next one is CPO, a bit similar in terms of the charts. For CPO, we saw a pullback in January. However, a higher low was formed before a rebound in the last week of January. So with the increasing momentum as well, potentially we could see a retest of the recent highs, again close to about 56.50 or a retest of 58.50, which is a higher resistance level, previous double bottom support breakdown for this counter. Next slide. Okay, last but not least is PTT. PTT's price action is likely to remain a bit flattish as it broke down an uptrend support line. And price action wise in January has been quite flat with just a lot of sideways trading. So there should be some near-term resistance about 155 to about 158, 159 area as well. There's some near-term resistance over there. But the support at about 146 area, which was a recent low, so it's likely to hold. So we are likely to see some continued consolidation for this counter in February. Next slide. As for our individual counters, we have technical buy for Nike, $103.27. Take profit levels at $110 and $116. Sorry, there's a typo on the chart for take profit one. For stop loss is at $100 and stop loss close at $100.71. So for this counter, trade actually hit our stop loss. For Nike, the trade idea was that the price actually pulled back to 61.8% Fibonacci retracement level at near the $102 level. And there was also a breakout of a downtrend resistance line with increasing momentum on both MACD and RSI, where there was a bullish crossover and some bullish divergence as well. So potentially the counter could have the chance to bounce towards these two target levels. Next slide. Okay, the other counter would be Thermo Fisher Scientific Inc. For this, it's a technical sell at $538.98. Take profit levels at $498 and $475 with stop loss at $566. The stop loss goes at $551.82 on Friday. So for Thermo Fisher, there was a retest of this downtrend resistance line, which acted as a key resistance for this counter. And it's also there was also a potential to break down of this short-term uptrend support line chart. Recent momentum has been quite weak as well, with bearish divergence recorded on both MACD and RSI, while the counter was making higher highs towards resistance. So potentially we could see a pullback in this counter if the bearish momentum sets in. Yeah. Next slide. So just to summarize the trades initiated, for Nike, it hit our stop loss, so it was down about over 3%. And for Thermo Fisher, it's currently in progress, down about 2% currently. So that's all from me now. I'll pass on my time to Paul to talk about Singapore with me. Thank you.
Yeah, thanks, Zane. Sorry, move on to the next slide. So in terms of some of the key macros that came out, we had actually positive numbers for Singapore. Manufacturing is actually 451.1. So this is a survey with purchasing managers to see how the orders, and it's actually the highest in more than 2 years. Electronics also was highest in 19 months. We had some visitor arrivals into Singapore data. It still continues to grow about 33%. And we are at 70, and we are still 70% of pre-pandemic levels, even though the growth was very strong. Supporting the arrivals into Singapore has been China arrivals almost 6 times or 600%. But even with such a bump, it's only 50% of pre-pandemic. So there's a huge room to recover. The key one in the US was the payroll numbers. It's actually a blockbuster number because it's like 353,000 jobs. Almost double the estimates and double even the pre-pandemic levels. But for us, at least, 2/3 of it still comes from government and healthcare. That shows that government spending remains the key support to the US economy. Again, similar to Singapore, manufacturing activity is picking up quite sharply in the US too. Next slide. So in terms of views, what does all this mean anyway? So in terms of our view, the most important news, I guess, was also the Federal Reserve meeting. So they kept the interest rates unchanged, but they also did mention that they are ruling out a March rate cut. But they re-emphasized that it's appropriate to reduce interest rates this year. I think most of the members agreed. So I think he kind of also said that the dot plots are still on track indirectly. The dot plots were that there will be 3 rate cuts this year. But the strong jobs number, which is down double the pre-pandemic levels and double estimates, is probably going to rule out any March cut also. But we think any cut the earliest cut is going to come possibly in May, because by then you're probably going to get 3 more inflation readings. And the reason they didn't cut was because they said not enough confidence that inflation is coming down. 3 more cuts, they better have more inflation, but then they better have more confidence with 3 more indicators or 3 more data points. But in the near term, it's going to be negative for REITs, because if the rate cut is delayed, that was one of the key catalysts for REITs. And like what Myanmar mentioned, 70-80% of them reported decline in their DPUs for the most recent December quarter or half. The decline average about 10%. You should expect DPU to continue to decline even in the second quarter and third quarter, because any rate cuts is only going to come into effect probably in 2025 onwards. Because most of their debt is hedged out 70-80%. In terms of Singapore, what are the hotspots in Singapore? They still are, but so the one is, of course, tourist arrivals. We're still going to get the big bump with the 30-day visa from China and also all the multiple events coming in Singapore. Construction is also positive, not only because it grew, I think, in the teens this year, the construction demand or construction awarded, but also the BCA actually raised their forecast. So BCA forecast is actually pretty accurate, I guess, since there's so many scholars there. But anyway, because they normally give a long-term guidance, but if you average it out, they're actually raising their forecast by 25% for the following years up to 2028. So what it means is that there's a lot of visibility that construction demand will be very strong in Singapore. But having said all that, it's going to be hard to unseat the US big tech, because the earnings from US, and these grew in the December quarter by 53%. So the trouble we're going to have is whatever growth story we have in Singapore is going to hard to unseat what's happening in the US. And they are growing 53% to 109 billion earnings in the December quarter alone. And AI earnings are just starting to flow in. So what I'm just trying to say is this is the wall we're going to have if you're trying to broke Singapore or to sell Singapore stocks. Some of the events coming up, these are results. Of course, for Singapore, the main one is going to have is the DBS results. The rest is Alibaba, PayPal, you can see from here. In terms of the events, so if you do have the time, feel free to register. We have three webinars happening by the corporates this week. Money Hero, which is listed in the US, but it's basically SingSaver. If you are interested to know how SingSaver make money, then you probably can join this meeting tomorrow. Emperador, of course, the whiskey owner and distributor, and then Resource Global, which is a coal company, shipment and also mining. Next slide. Okay, this is an illustration of some of the data. So for us, although there's job growth in the US, it may not actually be really economic driven, showing signs that the economy is improving. But of course, it's still going to be a very strong support to US consumption when growth is strong. So if you look at where the growth is, most of it is government, healthcare, social, the blue line. But the red line, you see, the economic sensitive one continues to deteriorate. And even though we have a lot of job growth, it's actually just continuing from the growth that was on par with what was happening pre-pandemic. It's just that when the pandemic happened, they lost almost 9 million jobs, and then it took until only 2022 to recover. So we are still in this replenishment of the kind of job losses during the pandemic. So you should expect jobs to continue to be still robust. I think we mentioned this a few months ago, Manny. Next slide. If you look at manufacturing, I think the one pleasant surprise is manufacturing actually doing a very sharp spike in the US and also in Singapore. Of course, if this continues, means it's going to be positive for the electronics, especially contract manufacturers mainly, because that means manufacturing activity is coming back. The reason why we still hesitate is this just inventory replenishment, because inventory has been wound down. But the uncertainty is this the part two, whether is this end demand driven or just inventory, just stocking back up the shelves. The next slide. So we'll move on to construction. So you look at this chart here, awarded. This is the annual contracts awarded, be it the public sector or also private sector. You'll notice 2006 to 2018 has been up and down, up and down. And 2013, 2014 was when we had the IR. But you can see how elevated the construction and how stable it is now as you move into up to 2028. Of course, there'll be some volatility. I just average it out, but it is still at elevated levels compared to the past few, the decade ago. If you look at the chart on the left, the one on the right is just to show the momentum, the 12-month momentum. I guess it's bouncing back up. The next slide. Okay, we go through our usual. We do a Singapore monthly now. Since if we do a Singapore monthly, if you have not received the report, just look up. It's already been issued, but we just do a quick review of our model portfolio and the market. So if you look at January, it was a tough month. The Singapore market was down 2.7%, and also in our model portfolio was down about almost 1%. But I think it's quite illustrative. You can see from here what did well, what didn't do well. Yeah. Next slide. If you look at the sectors, this is how we classify the sectors. I mean, so it might be different from others, but you can notice that almost all sectors are down except transportation. Transportation is up because of Yang Zhejiang. If you look at the top gainers here so the one on the top, the two columns on the top is top gainers. This is our mixture of 145 stocks, big cap, mid cap, and small cap. The big ones were Food Empire, Yang Zhejiang Geo, and the losers were, a lot of it came from the US REITs and tech names too, like AM, Nano, Film. The one at the bottom is more the index, the large cap gainers and losers. So the big ones were Yang Zhejiang and all this. Again, this is for illustration. The DFI or former dairy farm is the weakest. The next slide. And this just one last slide for me is the weakness across all assets except US equities. So gold was down, the one in yellow. Yellow is what happened in January. So gold is down, Singapore is down, everything is down except the US. Commodities slightly up. Next slide. Okay, there'll be no webinar on the upcoming Monday, February, because of Chinese New Year. But again, I'd like to wish everyone a very happy, healthy, and prosperous Year of the Dragon. Yeah, I think we can move on to Q&A. Thanks.
Maybe I'll take some of the Q&A first. Let me see. Okay, Andy asked, SGX's positives do not override the negatives, and they got a downgrade from you, yes. So I think, so the negatives, let me answer the first part first. The negatives still do, the positives still do outweigh the negatives. It's, mainly due to their continued growth in this, in the FICC commodities, as well as I think the only thing that we can sort of quantify and sort of, forecast would be the OTCFX revenue growth. So it's coming from a growth of a larger base, as well as SGX's efforts to continue their digitalization to expand further into the emerging markets. So that's how they are managing to grow this OTCFX revenue, right? And okay, so let me explain a bit on how why I downgraded SGX. Firstly, I think when the past few halves we were talking a lot about the treasury income, and it did rise. So it was sort of, I think, even surpassed our estimates of how much treasury income rose due to the higher interest rates. However, I think it didn't really reflect in their share price, and consequently we had to sort of lower our estimates because their equities, cash, and derivatives segment didn't do as well. Hence, we had to cut the revenue and the PATMI and the earnings that came in were actually below our estimates. Hence, we had to lower the earnings for full year FY24. Hence, that's why there was a lower earnings and revenue estimates. That's why we lowered the target price, and hence there was a downgrade. So the downgrade is more of the total return. So previously, I think the total return we were looking at was like above 20%, hence it was a buy call. But now because we lowered the target price, so now our total return upside is looking at around 13%, hence it's an accumulate. Hope that answered the question sufficiently. I think there's still a few more questions. Okay, please comment on CapitaLand, UOB, DBS. I'll leave the CapitaLand one for the rest of my colleagues. So for UOB and DBS, similar. I mean, even for other banks, it's quite a similar story. So we are looking at the higher for longer interest rates, which would sort of continue to benefit the banks. So we could see that they will maybe have a slight dip in their net interest margins, but it will still remain high. I think maybe only a single-digit basis point dip at most for their net interest margins. And net interest income should still come in at double-digit growth for full year 24 and even for the fourth quarter of FY24. And secondly, the fee income, all the banks are pushing their fee income. So we have seen that the wealth management arm has been quite robust. They have been growing their AUM sufficiently, but because of the current market, they are not able to charge as high of a fee as they were previously. Hence, even though their AUM grows, their wealth management fee income isn't growing as fast. And of course, the other one that they are also pushing quite hard is that they will see some growth. It will be the credit card fees because of all the recovery in travel, and especially for UOB specifically, they have a lot of tie-ins with all the concerts. So they are, you have to use a UOB card to buy this to buy their tickets. Hence, that's just the first step where they get in the initial revenue. But I think about how they maintain their customers after that initial first step. Yes, so that's for the fee income. And yeah, hope that answered the question. Okay, please comment on the current SGX market, likely factors that cause the fall in prices of most stocks, especially banks and REITs. Okay, REITs, I'll leave it to Darren. So that will cause the fall in prices for banks. So for banks, I think it would be the interest rate cuts. So the rate cuts, I think people are thinking that, high rates means high interest rates good for the banks. Yes, that's true, but conversely, if you look at the rate cuts, it will also be beneficial for the banks because they will be able to finally show some growth in their loans. So when the rates are very high, their loans growth actually took quite a big hit, and we could see it for the last few quarters already, where net interest margins are really spectacularly high, but loans growth has been also quite low. So that actually took a hit to their net interest income because the loans growth did not grow. So when there's a rate cut, I think that might cause the fall in the prices per se, but if you look at it on a bigger picture, it will also be beneficial for the banks because they'll be able to grow their loans, their base finally. Okay, one more. These are all of mixed questions, so I'll just leave it open. What are the impacts of China's real estate debacles on counters like OCBC, Yangzijiang? Sorry, where was it? It disappeared. Sorry, let me try to find the thing. Yangzijiang Financials and Yanlot. Okay, so for OCBC, I'll speak on OCBC. I think they have been drilled on this quite a bit recently, at least for the past few quarters. So they have come out to say that they do not have any exposure to the Evergrande and all the real estate debacles, and they've also been able to like very, very stringently check on the loan portfolio which they have. So they're not really very exposed to this China's real estate. However, I think in a bigger picture, if you look at China, I think it will hamper their growth slightly, which is why they went ahead to buy the Indonesian asset, they acquire the Indonesian asset. So they might be looking to not just fully put all their eggs in a basket and go all out China. So they might probably looking at ASEAN as well, which is why they are maybe shifting some of their focus away to Indonesia and rest of ASEAN. Okay, let me just look through again quickly. Okay, I think that's all I have for me. There's one more. Yeah, I'll hand it over. There's one more on Sam Holdings. I'm not very sure about that. Maybe if Paul could take that one. Okay, thanks. I'll hand it over to the rest of my colleagues. Thanks.
I take over. There's a question on Keppel. Keppel, what's the reason to reduce from buy to accumulate? I missed it. Okay, Keppel, is purely the change in call is purely because of the recent surge in the share price. Over the last 3 months, Keppel share price has gone up by 15.3%. Just last 1 month was 1.3% up. Then we raised our target price to 798, and that gives a total return of about only 14.1% based on the last Friday's close of 729. And therefore we push it down to accumulate, which is anything that's less than 20% upside. Yeah, I hope I explained that. Thank you. There's just following up on the question that Glenn elaborated on, what are the impacts of Chinese real estate on counters like OCBC, Yangtze Financial, and Yanlong. Okay, it's a little more a bigger impact on Yangtze Financial. There's about currently in their portfolio about 52 or half of their portfolio is debt instruments, debt investments that they have extended to the parties, and China as a whole, as a percentage of the total portfolio, is 73%. So most of quite a lot of these debt instruments is secured by properties. So any reduction in property value or defaults will raise the risk for these portfolios that they are holding on to. I think for that reason, Yangtze Financial is also been trading at a very steep discount to this book. Similarly, our view for Yanlong, again, they had issued a profit warning earlier on that indicated that the costs in the books put the ASP of their properties might come in below the costs in the books. So there is still a very strong pressure from the selling prices on the Chinese property market. But on the secondary listing, we track the secondary listings in China. The volume in the secondary listings has actually tapered off. It means the sellers who sitting on property is now either giving up and not selling anymore, or the financial stress for them has reduced. So that's the first step to something to a positive, but not enough to de-stress the entire sector. So Yanlong will focus on paying back the debt that they had for February this year. So all the cash flow will be going to that, and they will for 24, we think it's going to be a weak year unless the appetite from the property investors come back, or the confidence to the economy returns. Thanks. That's all I have for this question. Thank you. I'll pass on to the rest. Thank you.
Yeah, I'll take some questions. What is the outlook of S-REITs, and has it had been declined for some time now? Is it time to commit? Yeah, so the S-REITs in January and up to date, it basically returned some of the gains the sharp gains that it had since November. So since November to December period, it's up over 15%. So it's just returning some of the gains, and that's, I guess, basically because of last week also, like Paul mentioned that there'll be unlikely to have any rate cuts in March. So but they're still on track to have perhaps 25 basis points cut in the later half of this year. So the long-term prospects are for REITs, we still like it, even though there might be quite muted DPU growth as interest rates are still high and they haven't come down, haven't actually come down yet. So interest rates are still high, and yeah, so mainly is the near term, the sentiment was that no cuts in March, so which was why there was quite a sell down in like the STI as well, together with some of the REITs. So yeah, but long term we still like S-REITs because we believe we are waiting for the yield play, and price to NAV wise, they're also trading about one standard deviation below the historical price to NAV of about 1 time. So now it's about 0.9 times. So yeah, we still think it's a good time, and we are still overweight S-REITs. Yeah, so there's a question on FCT. So for FCT, any okay, so the buy call is purely for you play. Yeah, correct. Our FCT buy call is purely for you play because yet run the risk of slowing economy and high rate for longer term. Yeah, so for FCT, we like them because of the U play, and there's a lot of stability and resilience in our portfolio. So we anticipate about 5% rental reversions for this full year, and the portfolio is also resilient, supported by the low occupancy costs. So, and they also have a visible inorganic growth pipeline from the North Point City South Wing. They already topped up their share in next up to 50%. So that is a plus for us as well, as next is a solid asset. Yeah, so we are basically in FCT for the U play. As for REITs now, it's still quite hard to see much capital appreciation for any of the REITs, with the exception of maybe some of the higher risk REITs that are trading at like 0.2, 0.3 times price to NAV. So with the exception of those, that might have a potential to have a sharp rebound if things change for the better. But other than that, REITs that are trading around 1 times price to NAV, we do not see much capital appreciation potential in the near term because of the high interest rate still. So perhaps any meaningful capital appreciation will come next year, FY 2025. Yeah. What happened to Mapleship Pan Asia charged up so much? Appreciate some general comments on its yeah, so for NPAC, basically I do not see any news that happened today. I would assume it's more of the general market sell down. The DPU for the most recent quarter is down 9%. Yeah, so I do not see any news, so I'm not too sure. It could be institutions selling. Yeah, which is why it's down about 4%. Yeah, not sure if Mel has anything to add. I'll leave the question there. Please comment on CDL. The counter has been trending down. Yeah, so for CDL, they're also impacted. So first of all, by the declining investment property valuations that they come up with profit warning last 2 months ago. So we are waiting for that. So because of that warning, it's hard to see the share price really rally because of the warning. So in the near term, there will be some weakness and it will be trading around low. And because of the interest rates as well. So CDL, yeah, because of their business model and like developments and investment properties as well, they are really affected by interest rates. So high interest rates will continue to impact them. Yeah, so the sentiment for CDL is weak, but on a valuation perspective, they are trading at over 50% discount to NAV. So there might be some should things change, should the sentiment change, there might be a rebound potential, but probably not in the near term from from our expectations. Yeah. Yeah, so mainly we are waiting to see the FY results, which will be out later part of this month. Oh yeah, can you comment on Keppel DC REIT? Yeah, so for Keppel DC REIT, our target price is under review, but mainly they are affected by the China side, the Blue Sea, because they defaulted on their payments. So because of that, the DPU they did will like the impact of the non-payment for the Chinese tenants will impact DPU by about 6.5%. So that is quite a big hit for Keppel DC REIT. And right now they also have the Guangdong Data Center 3 as well. So they might divest that asset because and possibly they might look for new tenants as well. So for Keppel DC REIT, our target price is under review. Yeah, so please look out for any updates which will come this week. Yeah. Yeah, I think that's all for me. I'll hand over to the rest of my colleagues for now. Thanks.
I have questions on sets and KIT. So let me do that. Okay, sets increase in the cargo load factor due to Red Sea problems would increase its value. I first two things here to note is we after I think Paul in his equity strategy this morning, he wrote about this speaking to a port operators last Friday, which I also listened in. The Red Sea problem was actually very short-lived. Most of the container liners had excess capacity, so they could actually deploy their excess capacity to take care of the tight situation in Red Sea. So it's very short-lived, and it does not actually eventually did not translate into a very sustainable improvement in the cargo air cargo side. That means there's no if for maritime cargo to move to the air cargo first, it must be those very time sensitive cargos. The second thing is air cargo is very more expensive. So if the freight rates for sea cargo has already normalized to normal level, the demand for air cargo actually will come back down. So the increase in cargo load factors was probably not a Red Sea, not so much of a Red Sea, or even if it is, it won't sustain. But the question is, if there is an increase in cargo load factors, yes, definitely it will probably help sets, especially if it's increase is in Europe and North America, where sets has under WFS has a big exposure in the cargo segment in the two regions. Yeah, but it's only a one month data for North America, so we probably need to see a longer trend to tell whether things have improved. But going by the macro environment, it doesn't seem to point to an improvement in the PMI for manufacturing. So therefore, cargo recovery is probably have to see a much sustained expansionary in PMI numbers. Thank you. Next question is, hi Peggy, is it safe to enter further into KIT today after the acquisition of all the renewable energy assets? Furthermore, KIT has a dividend increasing policy for unit holders. Why is the unit price not running up? This morning I posted on P3 of KIT's announcement this morning. They're going to pay an enterprise value of 570 million Sing dollars to buy a bus operator in Australia. Out of this 570 million, they will about 400 million. We will have to raise funds from the market by issuing new units. And they based on their estimates, the numbers that they calculate, the placement price that they have assumed is 0.471 per unit. So there's a placement coming coming up very soon for KIT. So that's probably why everybody is hesitating. If even if for institutional investors who are able to participate in the private placement, they might even choose to sell off their stake first and take the private placement, take the placement and participate in the EFR. So I think that's probably the reason why the price is not moving. Yeah. Yeah, that's, I hope I answered that question. Thanks. Hi Peggy, what is your latest view on if China Aviation in relation to the oil price? The set results that's coming out at the end of February will be a good set results. They'll be in line of our numbers. In fact, the Red Sea issue had, when we saw a sudden spike in the late third quarter, early fourth quarter, the fuel price, oil price, they are able to benefit from the contango, and therefore there was a jump in earnings from trading. Overall, as you can probably tell from my slides from the air transport sector, China recovery is like tenfold this year compared to 2022 in terms of international volume, travel volume, and we're still 37% below. For passenger side, it's still 37% below FY19. So there's still a lot more room to catch up. So China Aviation will do well, because they are the jet fuel supplier for the international flights getting in and out of China. Thank you. So we still have a buy on China Aviation. Thank you. I guess that's all from me. I pass back to the rest of the team. Thank you.
Yeah, thanks. Let me just take on something. I'll pass it on to Zane. Please comment on Ping An Insurance. Yeah, so sorry, we don't cover Chinese stocks. You might have to ask our Hong Kong research. Sorry for that. Yeah. Please comment on the current SGX market, like factors that cause fall in prices of most stocks, especially bank and REITs. So for Singapore market in general, I think without stating the obvious, but we just lack growth. So Singapore's attraction, you like it or not, is all about dividend. It's just an income dividend yield is the main attraction if I'm a global investor or a regional investor. And without the cut in interest rates, I think that you're going to lose the appeal even more for SGX market. So for the banks, I think like Glenn mentioned, the growth may not be strong, but it will stabilize, and so long as they can continue to pay the payout, so their banks are paying maybe 5 to 6% dividend yield. So that is the attraction, and it becomes only more attractive if you cut rates. Yeah, and I think REITs already mentioned, so the DPUs falling and without rate cut. So in the end, Singapore market can benefit if there's a rate cut because it just makes the dividend yield or income part of it more appealing. But there's just no growth. Growth still comes from the US tech stocks. What's the market logic of treasury sell-off hits Asia that caused the STIs sell-off today? I'm not sure who said that, but okay. I guess if the rate of interest treasury sell-off means US interest rates go up, right? So bond prices down and US interest rates up. So again, this causes the delay in interest rate interest rate cuts, and this makes the appeal of financial assets or that less attractive. That's about it. Yeah, I don't think there's any major rocket science behind it. Just a typical thing, interest rate rise and then they'll just pull down equity valuations or equity stocks. I hope that helps. Okay, the rest is it. Your view on Singapore. So we still think Genting Singapore, of course, the coming December quarter should do very well. Or I think they better do well since the competitor has done like record earnings. But the question is just whether how much dividends they're going to pay. Yeah, they locked us out from any briefing because they said we don't cover the stock. But we don't go for the briefing, how are we going to cover? But anyway, so but I think I think in general the momentum should carry Genting up to even the first half of next year because of the, like we said, tourism is still very strong. And you still have the China arrivals yet to kind of come in meaningfully. So I think there's still momentum in Genting up to at least the first half. Then from there, like we always mention, tourism is still a discretionary item. You cannot expect this type of growth to continue to climb. Because Genting, most of the growth now comes from mass market. And unless you assume suddenly there's a huge middle class that's growing very strongly in this region, and then you can sustain for the next few years. But we don't think so. So I'm a bit more cautious in the second half of this year. Oh, why the word height in your slide? Yeah, so sorry, that's my mistake. So the slide, instead of rate cut in May, I put height. I'm so sorry for that. If there's really a height in May, I think got to probably got to buy all the inverse ETF or short the market. Market will show collapse. Yeah. Yeah, sorry for that. That's a mistake by me. Sorry, it's supposed to be a rate cut in May, the earliest. Okay, on the IPO, sorry, there's actually a briefing only on Monday. On Tuesday, tomorrow. I can only give better thoughts on the IPO, and we'll do the usual Phillip on the ground. I'm not sure if it's too late because we don't have the 12. Maybe you might miss it. But as usual, we'll do a Phillip on the ground because not everyone will have access to the analyst briefing. So that's why we do Phillip on the ground. So I'll probably do that for this new IPO to brief everyone, and hopefully try to invite them to come for our webinars. CLAS. Okay, I think that one. I'll leave it to Darren. Okay, this one is hi Paul. Another broker has upgraded their target price. Okay. But what about your site latest review? Okay. I think when you raise your forecast by 2-3%, in general, I think we try not to move numbers. I mean, we shouldn't actually. If it's earnings less than 5%, frankly, it's not meaningful. Okay, let me just give you a background. It's already very hard to forecast. Sometimes you ask a company, if you work in any corporate, you ask them to forecast. They themselves have difficulty forecasting. So for analysts to move the numbers 1-2%, sometimes we just, at least internally, we don't think it's meaningful. Because with the level of precision for analysts is not that high. I mean, so anything less than 5%, we try not to move. But again, I mean, everyone is different. I mean, I think it's also good to move the numbers. For us, I'm not going to change our view. I think the venture view right now might be it's a safer bet in electronics. So it's more of a relative bet. That means, in a very layman term, die less. I mean, right? If the whole sector is weak and then you decline less, so you are better relative. But for us, we're still cautious on it. We rather just buy when we think there's a stronger upturn, rather than play a relative bet for electronics. For us, we still like Valuetronics. Yeah, I know I keep repeating it, but the one that we like is because for that, there's visibility of growth because they got 4 new customers. And the downside is in a way capped because the company is buying back shares up to almost 60 cents or 5.5 cents. And they got almost 200 million, 100 over, or 80% of the market cap is cash. So for us, we are much more comfortable with that. Otherwise, we try not to play a relative game on electronics. Yeah. Okay, can you comment on KRT investing in Aussie bus assets? Sounds like KRT getting, yeah. Okay, so for bus operations, the one attraction you get, the biggest competitive advantage is the bus depot. So for that, the company they acquired, Ventura, the main barrier is bus depot. Because bus depot, if you have a good location, that's it. I mean, it's like you have a good location in Bishan MRT interchange. You're not going to, competitors cannot come in. But I'm not sure about the valuations, and I'm not sure of the ability to pass through the costs that well. So I'm a bit more skeptical. But you are right. I mean, they consider a competitor for them to come into Aussie assets. The good thing is they are paying top dollar, so probably should raise the valuations for Comfort's Australian asset business. But they view it. KRT views this as as an availability type of infrastructure. That means so long as you have it available, you can pass through all the costs. But I think we've seen ComfortDelGro that's operated in Australia, I don't know, more than a decade. It is not so simple to pass through all the costs. Yeah. Well, because not everything is so clear cut in the terms and conditions. Yeah, let's just say that. Yeah, thanks. Yeah, okay. In terms of Thai Bev, um, okay. Sorry. In terms of Thai Bev, there are a few questions. Why is the share price not moving up despite all the good news flowing in? Any upside with the possible relaxation of the selling alcohol to the public? I think they reduced the duties on the alcohol to the public. On the relaxation side, maybe I missed the news, but there continues to be a lot of good news on the macro front. But I think investors still need to see the earnings coming in, and also need to see the government announcing the big stimulus of the so-called digital wallet that we mentioned before. Until that, I think the market is still quite skeptical about the ability for them, the earnings to recover. Sabeco will be announcing results, if not today or tomorrow. Then we will try. They will be doing a briefing. I'll try and catch some of the key highlights, and then I will mention it. I will pass it on to the P3 community app. We usually put some comments after certain briefings. And if they do mention they see recovery, then maybe that could help the Thai Bev earnings, or Thai Bev stock share price. It's Sabeco, because they said any recovery is only next year, not 2024, not 2025. So of course, markets, if they can pull back any of the recovery guidance, I guess, then maybe there could be some pickup in the Thai Bev shares. Yeah. Okay. Okay. I think I'll leave it to maybe Zain. Zain, maybe I want to take on some, then we move back on to some of the fundamentals. Yeah, because probably a lot of people waiting for the TA questions. Yeah, sorry for that. Yeah, thank you. Let's move on.
Okay, thanks, Paul. I'll start with the TA. Yeah, so the first one will be on DBS. So I think for now, DBS likely to still continue this range consolidation over here, where we see support is likely between around 3160 and then 3140 as well. Yeah, then I think the resistance is above the 3210 level to about 3230. Yeah, so likely to still consolidate for a while. And for Far East Hospitality, it's also doing just some sideways trading at the previous resistance level of the 63 cents level. So I think for now, likely to still hold around 63 cents to about 65 cents, about there as well. Okay, then for Kavana, and Kavana is also just sideways for now as well. With support around the $40.70 level. So I think for now it might still just hold on for a while over here. Yeah, unless there's a break above this resistance line, then we might see price go back up to retest closer to about $47. Okay, next one is Keppel. Keppel did a retest of this $7.30 high, and we saw a pullback today. So I think for now we might still see a bit of a pullback or consolidation ahead. Perhaps with some support around the $6.95 to about $7.05 level, this range over here. Yeah, so we might see some consolidation first, given that it's retested the highs. And then for Centrepoint Industries, I think the trend is still going quite well. Recently the price managed to break this 565 level over here, and looks like still holding above it. So there's still potential for the price to go higher towards the next resistance, which is above around 590 to about $6. Yeah, for Centrepoint Industries. And then for Food Empire, is also seeing a strong trend currently. So it's still holding above this resistance, this trendline resistance above 133. It's just doing some sideways over there. So I would expect for now perhaps some consolidation at this zone between 133 to about 140 level. And as for UMS, following a pullback, it retested this uptrend support line from support at 126. Then currently doing a rebound towards currently 132, 133. So for now, I expect resistance coming at around the 133 to about 136 level over here. Then price might pull back a bit and do a bit of a consolidation for now. But I'll expect 128 to hold for now. So just some sideways trading first. Okay, then for Franken perhaps the price could move will move a bit lower to retest these lows at 126, 127 over here. Then you might see some sideways trading afterwards, similar to the range form over here. My comment on CLS, so this is Celestica. Okay, for this counter, it's still seeing a very strong trend. Currently still trading above this uptrend channel resistance. So I think the trend could still continue upwards. Looking at the weekly chart, I think $37 is a previous level to about $41. So that's the two next target levels for Celestica and the current uptrend. Okay, the next one will be Flex Limited. So for this, looking at the weekly chart as well, also showing a very strong trend similar to Celestica, breaking above resistance over here. Currently is at $25. So I think it could still continue to trade higher. The next key resistance level could come in around $28 for this counter over here, based on the weekly level. Okay, then for next one will be Corning Incorporated. Okay, Corning, after the earnings, there was a gap up to retest this previous resistance high over here, and then there was a bit of a sell down after. So for now, I would think that there could still be a little bit of pullback to close out this price gap over here, perhaps at 31, closer to $31 previous resistance. Then they might find some support for a bounce thereafter. Okay, then the next one is a Southwestern Energy Company. So I think for this counter, generally, it's likely to still find itself in the range over here. So after the retest of the $7 resistance, it did a pullback towards the recent low of about 640 until just some sideways trading over here. So for now, it's likely to see a bit of a range continue between 630 to about 630 about 660 currently. The next one we call Provu. It's just similar as well. Currently just finding itself in a range. Continue to find resistance at $108 previous breakdown level. Here we test on Thursday, then there was a pullback. Okay, so perhaps we could see the counter trade a bit lower towards the support level, close to $98, $99 again. Okay, next one is Genting Sing. Okay, for Genting, I think currently it looks like for now it's a bit of a range consolidation. There's still resistance at $1.03. So I think for now it might still do a bit of a range, but if it does the pullback, I think that likely support will come in around the 99 cents level where we had this horizontal support and as well as this trend line support over here as well. So for now, it might still consolidate for a while. And for Mapletree Logistics Trust, I think it might continue, it might extend its downtrend. So for now, it's trading this descending pattern over here. There was a range consolidation, but I think there's still some weak price action. So perhaps you could still see it go a bit lower towards 145, towards 145, that where there might be a stronger support level. This level also meets a previous support level over here as well. Okay, next one is Geo Energy Resources. For Geo Energy, it's still continuing on its uptrend. But for now, I think it's quite near a retest of the previous highs of at this resistance area of about 39.5 cents to about 40.5 cents. So at this level, I would expect some sideways trading by it. Yeah, given that it's reaching these previous highs. Okay, for AEM, I think currently downtrend is still quite strong. Last week the price actually broken below this 267 swing low level. For now, still no signs of any reversal yet. So I think for AM it might still go a bit lower. It's currently in this closing out this previous gap zone between 244 to about 244 to 261. So I think now we might see price go a bit lower toward the 240s level. Then we see whether there's some potential reversal signals coming. The next one is Keppel Pacific Gold. So we did a retest of the swing low support at 24 cents, currently rebounded a little bit. For this counter, I think for now it's likely to sideways for a while at this zone between 26 cents to about 28.5 cents at this level. Okay, then for Prime. Okay, Prime is still showing some weak momentum last week with a breakdown of this support line. So I think for Prime it might still go a bit lower if it continues, if it breaks below these lows. If it breaks below the today's lows, then it might see price go a bit lower towards 14 cents as the next support level for Prime. Okay, then some of the S-REITs. First one, CapitaLand Escort Trust. So for this, I think today it was ex-dividend, so there was a gap down over here. So for now, it might be some sideways trading. If it recovers back from this 93 cents level, then but likely to see resistance close to 95 to 96 cents. So still, I think still a bit of sideways trading ahead. The next one is Suntec REIT. Okay, Suntec is still continuing on its range, so I think that will still hold between this 116 to 121 range over here. Yeah. Okay, next one is Starhill Global REIT. Okay, for Starhill Global, today it was a ex-dividend as well. So there was a gap down over here. And so for now, there might be some resistance at the 50.5 cents level, which it held prior to today. It might go a bit lower towards 48 cents for some support before a rebound. Yeah, for Star Hill. Okay, let me look at the next few counters will be some Hong Kong names. Okay, first up, Alibaba. Okay, I think for Alibaba currently it's likely to be still quite muted. It's currently in a bit of a range between this $69 to about $73. So I think for now, like we still hold within this range over here. Today rebounded from a test of these recent lows. So there might be some rebound towards $72, $73 in the coming days. Okay, then for JD is still showing some weakness, pulling back from a retest of a prior support at $93, $94. So I think we might see a price go a bit lower towards the retest of these lows at close to $81 to $82 before we see a slight bounce again for this counter. Okay, then next one will be Hong Kong Exchange and Clearing. So for this, similar to JD as well, it's still showing some weak momentum so pulling back from a retest of the prior support breakdown at $244. So we might see price come to retrace a bit further towards closer to $220 over here. Then there might be some slight bounce thereafter. Okay, the next one is a BYD. Okay, BYD is also showing some weak momentum currently. Since the breakdown of this downtrend channel over here, I think the price might go a bit lower towards 165 towards this $165 support over here before we might see a bit of a bounce coming. Okay, then for Tesla, I think for now it's likely to see some range trading for now. Support is coming close to $182. So for now, we might see a retest of the recent highs around the $194 to $196. Then we might see price sideways for a while. The next one is IJM from Bursa, Malaysia. So for this counter, it actually retested previous swing high resistance at 225 at this level. So it's currently doing a bit of a pullback for now. So maybe some sideways price action currently with between 215 to about 225 for now. Yeah. Perhaps I hand over time back to my colleagues to clear some of the questions first. Thanks.
Peggy, you take the Centrepoint.
Okay, yeah. The question is, Centrepoint, why below 10 cents? Can any bad news like rights issue again? Okay. Centrepoint had an announcement earlier to say that they are going to have a significant write down, so that for the after the review following the merger with KOM. So and as at June 2023, they had short-term debt of about 2.4 billion that they need to refinance. So I just did the rough calculation. I think they still probably need to resolve about slightly more than 1 billion of this debt. So with the write down in the value in the value of its assets, so that will probably bring down its balance sheet even further. So we think the market is expecting some really nasty numbers from this review and the write down. If they cannot solve their short-term debt issue, they would need to quickly raise some funds, and the easiest way right now is probably from the existing shareholders. But I can't confirm whether that will happen. Yeah, that not really no clue on that part. Yeah, thanks.
Thomson Medical.
Okay, yeah, I was just looking at Thomson Medical. Is the it's looking cheap now compared to the other it used to be much more expensive than the other tertiary care business listed in Singapore, but now it looks really fairly valued now. The recent price correction has been also reacting to the news that the CEO in the TMC Life Sciences, which they own 70%, that's listed in Bursa. They suspended the CEO, which was a bit of a surprise to us, and the word suspend is quite scary. So we don't really know what happened there. But TMC also just released their results last weekend. They more than doubled their profit in first half 24, which ended December. So the numbers are on the numbers front, they are shaping out quite well, and the development of Iskandar, the plans, if they announce any concrete plans on how to develop the medical hub in Iskandar, that will bring on another new stream of income for TMC as an operator of the Iskandar Medical Hub, and also from Thomson Medical in the whole core here for developing the rest of the land into a mixed development of medical resource, residential hotel. Yeah, so potentially could be an interesting company. That the only probably things hanging at the back of our mind is why the suspension of the CEO in Malaysia. Thanks. I hope I have answered that question. Maybe I take the other one. Any news on Novo Tillers? Novo last Friday announced that they are going to redeem all their shares, A shares, at $5.18. That's about 3.6% higher than the original issue price of $5. So the price has risen in reaction to this. But from here on, after redemption, it will be going through a liquidation, and then the company will not be in existence anymore. So yeah, so just it's not much if you buy the stocks right now, it's really more to gain that little spread between whatever you're paying and the $5.18. Otherwise, not much reason to buy Novo Tillers. Thank you. I think I pass back to you, Paul.
Darren and Mel.
Yeah, just now there was a question on Maple Tree Pan Asia commercial chart. Yeah, so why did the share price go down? Actually, it's because today is the ex-dividend date. Yeah, so that is also together with CapitaLand and Scott Trust as well. The dividends down, or not dividends down. Sorry, today is the ex-dividend date. So there's a question. Class does not seem to be performing despite tourism travel recovery. Why? So yeah, so few reasons. One of it is the interest rates for sure. Like I mentioned earlier, no rate cuts in March. So probably the rate cuts will come later part of the year. So there's this near-term sentiment thing, sentiment issue where rate cuts are high for longer. And then another issue is because of their private placement shares they did late last year. So there's still a bit of overhang there. They should 10% more shares last year. So that is yeah, quite a drag. But despite that, Class they did release some good set of financial results. Yeah, and the target price is under review as well. So yeah, the updates will come by this week. So yeah, the DPU is up 16%. RevPAR numbers are all up, but looking at growth potential year on year, it might slow in 2024 because of a very high base in 2023 for RevPAR numbers as well as tourism and travel recovery. Yeah. So I hope that answers the question. And yeah, there's another one on the NYCB, the New York Bank saga, highlighting the challenging US commercial real estate situation. How would you see this evolve, and will this affect US office REITs this year? Yeah, so basically the US office REITs, the valuations, rather the US property valuations, they are all down, and as a result, there's also not much transactions going on. So how does this affect the US REITs? Yeah, the US office REITs, they all we all expect further devaluations. So I believe Keppel, they release their year-end valuations is down. I can't remember exactly the number. If I'm not wrong, I think it's 7%, and Manulife is also down. So we are waiting for Prime US REIT to release. And yeah, Prime specifically, they have about a 13% asset devaluation buffer before they hit 50% gearing. So yeah, so that is they have to avoid that at all costs. If not, it will be like a Manulife Part 2. So yeah, hope that answers the question also. Yeah, hand over to Miao. Thanks.
Yeah, thank you, Darren. The metrics for Sasha looks fine, but the only weakness seems to be the strength of SGD versus RMB. Why has Sasha's unit price has been declining for the last months? Yeah, so one of the factor is as Darren mentioned, it's done because of the interest rate outlook has changed, and then another factor is mainly due to the weaker macroeconomic outlook of China. Yeah, so the metrics is not very good for the overall economy. Yeah, so DPU will continue to be dragged by the FX. Yeah, but once again, like the CEO Cecilia mentioned last week, the nature of Caesar rate is counter-cyclical. Like when the general economy doesn't trending good, yeah, the outlet malls tend to outperform. Yeah, compared to the general typical malls. Yeah, especially when the middle income family in China has a very big portion. Yeah, and then they'll have their FY23 result update next week. Next week. Yeah, so we'll update after they announce. Yeah, hope it answers your question. I'll hand over back to Paul. Thank you.
Okay, thanks. So there's one question on Oceanus. So for those who don't know, I mean, Oceanus, a former abalone seller, now turned distributor of seafood. The results is actually good. They actually grew the revenue almost 50%, but I think the issue doesn't seem to be able to get much operating leverage, so they're still loss-making. I guess for me, the main story there is that they are becoming a sourcing agent for food security products for selected countries. I think especially for China and so forth. But just that the financial numbers don't look that attractive right now. Yeah, although the gross profit went up, but OPEX also went up and interest rate almost doubled. So I think they still have to get some leverage, because if you get a 40% jump in revenue and your earnings don't really move, then the cost structure needs to be realigned. I think this is just stating the obvious. Thanks. Okay, I think we done most of it. Okay, I'll hand it back to you, Zain, if you want to finish off anything else. If not, yeah. Just do a quick one and clear everything.
Yeah, okay, I'll just do a quick one of the remaining questions. Okay, the 3032 Hang Seng investment tech ETF. I think for this, starting to show some some support around the 297 this level. So we might see some bounce ahead towards 310, 314 perhaps at least for now. Yeah. The next one is 10 cent. Okay, for 10 cent, I think probably some sideways trading first. Forming higher lows, but also lower highs at the same time. So I think price might be kept between like 273 to 285 around this area for now. Okay, then for Ping An Insurance, I think yeah, it did a retest over here, and if you can hold at this level, which is around 31.50, I think the price might bounce a bit towards 33.50 33.50 to $35 in the coming days. Okay, Yang Zhejiang, is it a buy at this price? For Yang Zhejiang, there's some signs of weakness. So it looks like it's breaking down this very steady uptrend channel over here recently. So I think it will be probably a buy at lower price. I think it might pull back towards this higher resistance over here, 156 to 158. Yeah, it might be a better buy at these lower prices, in my opinion. The next one is Parkway Life REIT. I think for Parkway Life, they probably is doing a range between like 343 to about 365 for now. So recently there's a resistance over here. So I think we might see some pullback towards some lower prices in this range over here for the time being. Yeah. Okay, the next one is Centrepoint. So I think Centrepoint is still showing some weakness, breaking below this 0.101 level. So if it continues on this bearish momentum, I think we might see lower levels. Looking at the past, there was a previous swing low close to 0.093. So there might be it might go down to these lower levels if it continues its bearish momentum. Okay, next one is China Aviation. I think for China Aviation currently still held in the range for now. Yeah, so likely to trade between the current price 87.5 cents to about 90 cents for the time being. Okay, then next one, Thai Bev. Yeah, Thai Bev still finding resistance along this blue color downtrend resistance line, so it can't hold above it. So I will expect some a bit further pullback for this to retest the lows around here, which is around the 49 cents to 50 cents region. Then let's see whether it can just form a sideways afterwards. And the next one is Venture. Okay, for Venture is doing some range consolidation for now between like 1330 to about 1390. So if there's a break above these highs, I think it could move a bit higher towards like 1420, 1430 as the next resistance level. Keppel DC recently retested the October lows over here. And there was a slight bounce and price came back down today. So the momentum is still quite bearish. So I think there might be still lower lows to come if in the coming days if there's a breakdown of these lows at 162. So the next support level that might come in for this counter will be closer to 156, 157 now. I think the next one is Ascenders REIT. So for Ascenders, there's also a breakdown today below this support 286. So I think the price might go a bit lower towards 275, 275 over here perhaps. The next one is Sense China. Okay, Sense is just sideways for now. So price rebounded from another retest of around the $20.50 levels. I would think that price will just sideways between 21.50 to about 22.80 for now. Yeah, for the time being. Okay, then for sets, there was a retest of this breakdown over here of the uptrend channel. So I think price might just hold between 274 to about 284 this trading range for now. Okay, then next one, nano film. I think nano film is currently we tested the this downtrend channel support over here, this black color line. So if it holds, then it might just do a bit of a sideways over here first, which is around the 67 cents to about 70 cents zone. Yeah. Okay, the next one is Meituan. So Meituan, I think currently it's just still finding support around the 62, $63 level over here. So if this holds, they might see some rebound towards 67 to about $70, which is a recent highs over here. Okay, then for Raffles Medical, it's still trading in this downtrend channel over here. Recently breaking down this support at $1.04, still a retest of recent lows at $1.01. So probably some sideways price action for now. Okay, then for next one is Riverstone. Okay, Riverstone, yeah, likely to see price attempted to break this downtrend resistance line held at 70 cents over here. So maybe some bounce towards the highs at 73 to 74 cents again. Yeah, but likely to cap in this range between 70 cents to about 74 cents. Okay, then Del Monte. Okay, Del Monte actually went to retest back a previous resistance around the 11.5 cents level. Yeah, so it might just sideways between at this current range of 12.5 cents to 13.5 cents. Yeah, but the volume is actually very low. So in terms of the TA wise, it might not be as accurate. Yeah. Okay, Samudra Shipping, yeah, breaking down after the breakdown of this ascending wedge, here retest of the 68 cents support level over here. Starting to see price sideways over here. So if this support holds, I think it might just sideways between these 68 cents to about 71 cents zone for the time being. Yeah, then I think I'll just take one last one, the hourglass. hourglass question. Okay. Okay, for hourglass, I think yeah, it's still since breaking down these head and shoulders over here, right? The neckline of 185 is just trending downwards. For now, I see it's probably this down is trading in this downtrend channel over here for now. So I think that will still probably continue with near-term selling pressure and resistance close to 162 over here for the time being. Yeah, so I think that's all for me. I'll pass back the time to Paul if you have anything to add on. Yeah, thanks.
Yeah, okay. Anyway, thanks everyone again for always joining our webinar and for all the questions. I'd like to wish everyone a very happy and prosperous Year of the Dragon, and more important, a very blessed and healthy Year of the Dragon. So with that, I'd like to thank everyone for your time. There won't be any session the following Monday, but we'll return the next Monday. So with that, thank you everyone for your time and really have a blessed year ahead. Thank you, everybody.